and we still have weather concerns. The Central Plains in the US have areas that are dry. We are concerned about continued liquidation stateside. And that's already impacted some of these numbers because it means that we're not into a rebuilding mode like we were back then, but that we are looking at smaller production, not just this year, but most likely next year if we get rain and heifers can be retained. And that's why a big part of this on the supply side, the story is actually very different than 2015. But the risk side that I want to talk about, and I'm going to spend more time on demand today than you guys want to hear, that's okay. I don't normally spend a lot of time on demand, but this is where a bunch of the risk is that we face this year. So the majority of our beef goes into Canada, the US, and Japan. That's 94% of where our volume goes. And so that's where the consumer demand that we have to be looking at and what's happening with those consumers. Our international exports last year at over 500,000 tons made record highs. We're back over that 2002 volume number. We've seen really solid international demands and really solid gains into Asia. Japan was up 17% last year, and we've seen, you can see that, just tracking up in these recent years since CPTPP came into effect. We've also seen a big jump here. Oh, can you see this? There we go. Big jump into South Korea. South Korea actually had 100,000 tons of beef where they removed the tariff on from July to December of last year in order to bring in more product and control food price inflation. Food price inflation is a real concern for governments right now around the world. And so wanting to make sure that if they're a major importer that they get that product. That removed our tariff disadvantage against the US and Australia for South Korea during that time period. Things have changed in South Korea now, but it's one where there's been really strong demand in a lot of these countries. And when we think about those two main export countries of the US and Japan, when we think about this food price inflation conversation, these are two countries where we've had modest to stable increases in terms of our export value. And that's really important because some of these countries that are seeing big jumps in the per unit export value, it's because they're experiencing really high levels of food price inflation, and that's eroding their consumer purchasing power. And it's really impacting potentially demand for some of these countries moving forward. So in the first quarter of this year, we saw beef exports up 5% in volume and value, but the bigger thing is that in March we saw it down 10%. And this is one of concern, as are we seeing the shine come off of some of these export markets. We saw Mexico open up to Brazilian beef and pork as of March 6th, again in an effort to control price inflation. But we continue to see strong movement into the US. Japan is softer. Part of what's impacted the Japanese market for us here in 23 has been exchange rate movements, which has made us uncompetitive with some other suppliers. And as we've seen some volatility in the banking sector, that is potentially going to continue as exchange rates impact our competitiveness internationally. I mentioned things have changed for South Korea. They actually are liquidating their domestic herd, which has increased production domestically and softened their demand for imports. So last week, Statistics Canada came out with consumption data for 22, and we saw per capita protein consumption here domestically increase for all the proteins. And it really showed really strong resilience of the Canadian consumer, who is our major consumer, of the priority they have of putting protein on the center of the plate. And so we saw beef per capita consumption up 3% to 17.5 kilograms. We also saw pork up 6.5%, poultry up almost 2. Sea fish was up, that's 20%, but it's a really tiny consumption, guys, less than 5 kilos. It is a record high for sea fish, but it's one where we live in the prairies. We don't eat a lot of sea fish. The reason we have it is because we compare this data internationally to other countries where fish is actually the dominant protein that's being consumed in some other places. But we've got to remember that what's the context of that big jump in per capita consumption? And the fact that in Canada, back in 2021, we saw beef really lead food price inflation here in Canada. And that really put us out of a lot of price relationships with other competing proteins and substitutes. I did a lot of media interviews of why beef was so expensive. But in 22, we actually saw a lot of those other food commodities catch up to beef and close that gap, putting those price relationships back in alignment. And so inflation that consumers were seeing, up 6.5%. We've got the Conference Board of Canada talking about the average Canadian family spending an additional $1,000 in groceries this year. But we need to remember that in North America, where the majority of our beef is being consumed, that the percentage of income being spent on food is relatively small. And so it is a question of willingness to pay. And are consumers really looking to continue to have protein, and specifically beef, on the center of their plate? In terms of economic drivers, there was expectations that a lot of the COVID stimulus spending was going to support savings and spending throughout 2023. They're now talking through the third quarter, and maybe even shorter, and that we may then see some change in consumer behavior going into the last part of this year in terms of how consumer spending could be pinched. But with those higher deflated prices, higher per capita consumption, we saw demand up last year, and this puts us back up at the high that we saw in 2020. And we need to remember what COVID did in terms of consumers and their relationship with food, because I don't think it can be underemphasized in the fact that when you lock everyone at home and you force them to buy at retail, you're forced to learn how to cook. And you can only stand bad food for so long before you actually learn how to cook. And a lot of people actually learned how to cook not just a steak on the grill, but a variety of protein options, and they learned how much further their food dollar went at retail. And so this is something that has the potential to support demand, not just for a year or two, but in the coming decades, as we've had an entire generation that's been impacted by this. We also need to remember that demand is not consumption. I mentioned North American supplies are tightening, and I'm going to talk about that more later. And as we see tighter available supplies, that means that there will be smaller per capita consumption because there's just less beef available. But demand is not a measure of consumption alone. It's that willingness to pay, and it's really that combination of price and quantity around expenditures. And are they willing to pay that higher price to put it on the plate? And that's one of the things that we really watch. So what's going to change consumer behavior potentially? That is these price relationships between the competing proteins. And so you can see that in the first quarter there of this year that retail beef prices are back at the high levels that we saw in the first quarter of last year. And really, it was at that time when we were out of our historical price relationships with pork and poultry. And that means that there's incentives for consumers to start switching to substitutes. If these price relationships have that adjustment that we saw in the second quarter last year and go back to those historical price relationships, beef tends to perform fairly well during a recession when there is challenges in consumer confidence. And you tend to see more switching down within the category from high-end middle meats down to ground beef versus switching between categories to meat substitutes. But you can see here that we are at that pushing that top end in terms of those historical price relationships right now with pork and poultry, and are looking to have that adjustment in the second quarter so that we don't have demand erosion at the meat counter. So what is one of the things that is going to potentially prevent that? And the pork sector has been on an interesting ride in recent years. In 2019 and 20, African swine fever hit China and really decimated their pork industry. And in response, we had a lot of countries, including the US and Canada, increase production. So you can see that spike back here. And Canada basically just incrementally increased so that we're record high production in the last 3 years. But this was one of, with the goal of being able to export to China and build market share there. Well, the concern is the fact that China in 22 got back to full production. They have a commitment to self-sufficiency in pork. They're not interested in those imports anymore. And as there were adjustments coming back, the expectation was that pork production was going to be lower here in the first quarter. And it really did come in larger than expected and has really pressured pork cutout values. On top of this, we have Proposition 12 in California, which is impacting interstate trade. And there's a lot of question marks about how it's going to be implemented, how it's going to be verified, and how it's going to impact prices and trade within the US, but also across North America, because California imports a significant portion of their pork supply. One of the things, as we've seen pork with these lower cutout values pressured on the supply side, is that combination of pork tends to appeal to a low-income consumer historically, and they have been the ones that have been the most pinched by food price inflation and have the least reserves in terms of savings going into this, which means that they're facing a high supply situation right now in the North American market with a low demand. And so right now, the price spread between beef and pork on the wholesale side in cutouts, and this is US data, you can see this green line, that's your wholesale. It's only been this high 2 other times, back in 2020 and 2015. And there's usually then that lag effect before retail prices actually catch up, where you actually see pork loins at fire sales at Costco. And we all remember them because we all bought them and filled our freezer because it was a good deal. But that's potentially what's coming later this summer that's really going to pressure this demand side on potential demand erosion. On the poultry side of things, we've seen really strong historical growth in global poultry production, but that's really been tempered here in recent years. It's slowed off, and that's partly because all of the livestock industries are being impacted by record high grain prices. And it's one that we may talk about record high prices and surpassing 2015, but record high prices does not mean record high profitability. And if you were gonna go back and look at what we were at for grain prices in 2015 and say, okay, with that implied profitability at the feedlot sector, what kind of a fed cattle price would I need right now with current prices to get back there? We would need fed cattle prices up 50% from last week's record high over $240 per hundredweight. And so it's one that can blow your mind of that profitability is not there. And all of these protein sectors are being squeezed like this, where something has to change. If these feed prices are here to stay, all of these proteins have to level up to get the margins back in the business. Or we need these feed grain prices to drop. And when feed grain prices drop, it actually is not a good thing for beef cattle, because pork and poultry with a shorter production system can respond so much faster that they can increase production and drop prices at retail, and then we have the exact same challenge of demand erosion with our relative prices at the meat counter. And so where do you go from there with record high feed grain prices? And what we've seen over the last 20 years is that there's solid demand for proteins. We've seen global GDP double in the last 20 years. There is demand for high quality protein. But where it's coming from is grass-fed and buffalo meat, and not high quality grain-fed. Increasingly, we have high quality grain-fed supplying a niche consumer who has the willingness to pay for that product. So we're going to switch gears and look at domestic supplies and prices. And one of the big question marks for a lot of people on the prairies is the weather. Matt Makins has been doing a quarterly weather outlook for us at CanFax over the last year and a bit. And last week, he released his June report for the summer. And you can see on the graph to the left that it's sort of normal with spotty precipitation. Some of the light yellow areas are drier than normal. There's very few light green areas that are slightly wetter than normal. But the bigger thing is on the right side and above average high temperatures throughout the summer that will be impacting evaporation and pasture conditions. And this is one that, as I mentioned, the US has gotten some winter storms that improved soil moisture conditions in a number of regions, but they do still have areas that are dry as well. So cow prices hit a brand new record high last week at $154 per hundredweight, and we have seen the largest spring rally since 2008 from January till now. And it's one where during a recession, when you have strong demand for grind, it does typically support the cow market and strong prices, but like I said, are we at the roller coaster? Are we above the precipice? Or are we going to track sideways over the summer here? And that really is the question of how consumer demand is going to hold up over these summer months. Our production here in Canada looks like it will have peaked last year and looking to be down anywhere between 2% and 4% this year. And we need to remember that while we may have a significantly smaller cow herd than we have had in the past, beef production is about pounds of beef produced. And that's impacted by our feeder trade as well as our carcass weights. So year to date, overall, our domestic production is down about 5%, with the big portion of that being reduced fed cattle production. Our production right now is being supported by larger cow production on the non-fed side. And this has really seen a shift in leverage. Last fall, we had heavy carcass weights. Our feedlots weren't very current. Even in January, you can see that red line above the 5-year average, even above year-ago levels. But in the last, basically, 2.5 months, we've seen that leverage shift as feedlots have gotten significantly more current. Carcass weights are now the lightest since June of 2019, and we're down 2 pounds from our 5-year average. This has happened really quick, and part of this is just smaller supplies, but also a shift in rations where cattle just need some more days on feed before coming to market. So I mentioned feeder trade, and our beef production is really impacted and has been impacted by our net feeder trade as we became a net importer in 2019. And those red bars from September through December last year show that we had larger net imports, and that really helped us offset our smaller calf crop in terms of placements into feedlots last fall. However, in the first quarter here, even though those blue bars are well above what we saw in the first quarter of last year and even the 3-year average, it just really hasn't been enough to offset those smaller supplies coming forward from our domestic herd. And what that means is that fourth quarter placements were about steady with a year ago. And that means that even though we're really current with carcass weights, those cattle are there, they were placed last fall. It's just the fact that they need anywhere between 4 and 6 weeks more days on feed. In contrast, we know that placements in the first quarter were down 12%, or 54,000 head. And that means that we know we're going into tighter supplies here in Canada in the second half of the year. And that's going to be incredibly price supportive going into basically that September-October period when we normally have our lowest fed cattle prices. The other thing that's been supporting our production in the last couple of years has been our heifer placements as we've had drought and those have been moved to town. We saw with that rain last June, heifer placements into feedlots dropped back to our 5-year average right through to October. But then in November, December, and the first quarter of this year, we saw those heifer placements pick back up again. And so it's really indicating that cow-calf producers are not in retention mode yet. There's still concerns about pasture conditions, but this is also one of the big swing factors in terms of what can be happening with our production going forward and if it can be larger or smaller. So getting into prices as we get close to wrapping up here. We have made new record highs this spring. I mentioned that last week we're at 242 at the feedlot. And basically, when we look at the live cattle futures, prices are projected to stay strong in the second half of the year. So this is our normal seasonality in those red dots, with a low in that September-October time period, and then things picking back up in December as we go into the holiday banquet eating demand time period. And you've got to remember that that fourth quarter, we talked about the US having that 8% drop in supplies. That's part of what's supporting that fourth quarter. But you can see here that we're basically blowing out of the water any of those 2015 numbers that we had previously seen. And those projected prices included a week basis. And the reason for that is last fall we went to the weakest basis since 2014. And you can see when I talk about weak basis, here from 2015 through the first half of 22, there we go. Basically, these were strong basis years. Weak basis, you're looking at historically something closer to this. So the difference between a strong basis year and a weak basis year is about 15 cents per pound. And the big difference between your 5-year average is the fact that you're weaker in the first quarter and the fourth quarter. And we've basically seen that hold true here this year, as that green line shows in 23. We were even weaker than our weak basis years in January, February, and then we're tightening up here April, May. And typically you see a weak basis year pretty steady with the 5-year average from May through September before being weaker again in the fourth quarter. And on that previous chart with those projections, we've included a weak basis year. So if you're optimistic, you can add to that projection. We're just trying to be conservative. For those of you with yearlings, we've seen really solid support in terms of the feeder futures, and the feeder market's been really strong this spring. with tighter supplies expected. There are obviously grass concerns in some regions. We've seen some more volatility in Ontario, for those of you on the eastern side of the province who sometimes ship that way. But basically, we're seeing, steady increases so far this year. When we look at the feeder futures, we are looking at prices in the third quarter surpassing 2015. This on the chart here is from Price Insurance, and some of you will have noted that these numbers came down here over the last week as we rolled over from the June contract to the August contract in terms of the nearby. So we're still seeing really strong prices here for the feeders. On the calf side of things, we have been hitting new record highs over the last 5 weeks or so. Things have been significantly more volatile in Ontario, but we are expecting things to be fairly flat throughout the summer here. And one of the things to remember about this calf market is last fall when we had that big jump up in August, September, 60% of that price increase was driven by the change in the exchange rate alone. We've since seen that Canadian dollar fairly stable in a fairly narrow range and not expected to move a whole bunch. But this is one that we need to remember that that big jump was largely exchange rate driven, and here in the spring of this year, it's been more fundamentals on the supply and demand side of things that have been supporting those price increases. So one of the things that's going to impact feeder prices this fall is feed grain prices. And this is one where Alberta barley is the highest price on this chart. We are price uncompetitive, but you can see that we've been moving down since January. I noted that we've got lighter cattle that need more days on feed. Some of these guys have incorporated cheaper oats into their rations in order to cheapen up cost of gain. There's also looking at other alternatives for feed as well, whether that's bringing stuff up from Montana for barley prices or looking at other alternative feedstuffs. But for about every dollar per bushel change in barley prices, calf prices can change about $20 per hundredweight. And this is where we could definitely see some fluctuations as there are concerns about feed and the grain market this summer. So again, Price Insurance is basically putting calf prices in the top coverage level right around that 320 for the fall run, and that's significantly different from what we saw in 2015, where prices dropped pretty sharply from August through December. So in summary, what are some things to watch? We've got tight cattle supplies. And we know we're going to have tighter cattle supplies coming forward into the second half of this year and even into next year, both in Canada and the US. In terms of leverage shift, we've seen a lot of that leverage shift already happen in the last 3 months from the packer to the feedlot. In terms of consumer resilience, this is where I see a lot of the unknowns and question marks. We've got food price inflation, and it's really unclear yet how this is impacting our domestic and international consumers. I noted that the exchange rate fluctuations have impacted our competitiveness in some of our key markets, specifically Japan, and that pork cutout, which is struggling in North America and has the potential to provide some changes in our retail price relationship here moving forward over the summer. Our big risk is weather and what happens in that grain market. And then, as everyone knows, controlling that inflationary input costs because it is really squeezing margins, even though we're seeing higher price levels. So lots of you guys know our weekly report, the 4-pager. I just wanted to point out we have a number of free resources on the website. This is our spring fact sheet that's available there on economics of replacement heifers, but there's lots of other resources that you can check out on the website, and we'd be happy to hear from you, and I think we do have time for questions.
We do have some time for questions. We got about 10 minutes or so if you have any questions for Brenna. Richard, you must have one. Not even from Richard. Looks like we might have a question coming up here pretty soon. All right. You did such a great job, you left everybody in awe. That's what happened. Answered all their questions. Do you see, you mentioned the cattle or the calf population down a little bit, the numbers down a little bit. Do you expect growth on that pretty soon?
Yeah, so I mentioned those heifer placement numbers into feedlots, and the fact that we're 30% above our 5-year average and still placing those heifers into feedlots does not look promising in terms of expansion on the cow-calf side. And it's really one that we really do need some improvement in pasture conditions and feed supplies.
All comes down to Mother Nature by the sounds of things. Any other questions for Brenna? That looks, oh, we do have one back there. Your name, please?
And grass-fed and buffalo, and the need for protein in diets, but where it's being purchased from. And earlier on, you alluded to, I didn't hear the first part, but I think it was about cooking, learning to cook, and this new generation. So I'm kind of curious how buffalo is being prepared. Like, how are people knowing how to prepare buffalo?
Okay, so two different contexts there. The comment of growth in grass-fed beef is on the global market. So in terms of where beef is growing globally is grass-fed countries like South America and buffalo meat out of India. And a lot of that buffalo meat is going into the Middle East and into Asia. And it's a very different product, East and into Asia. And it's a very different product. It's got a different texture for cooking. And so it's one that when a lot of these consumers that have been eating plant-based proteins and they're wanting to up-level their protein consumption, they're looking for the next most affordable thing. And buffalo meat is sort of priced on par with poultry in a lot of those countries. And so it's usually a lot of just ground beef for those countries. But I think it's a really good point you make that it wasn't just consumers here in Canada that were in lockdown and learned some cooking skills. It was consumers around the world in a lot of different countries who were also in lockdown and learned some cooking skills. I would say that a lot of those other countries had more cooking skills than North America and Europe did going into this.
I'd like to talk to these people who developed their cooking skills because it sure as heck didn't work for me during the pandemic, I'll tell you that much. Tyler.
Hi, Brenna, thanks so much for the presentation. I recently saw, I guess, a bit of an analysis on beef demand, like very recent beef demand in the U.S., suggesting I think an 8 to 10% drop in demand for the month of March. So, you know, take it for what it's worth. It's one month, and citing the concern really over household spending and the pressures that interest rates have had on households. Is there a previous precedent for that kind of demand reduction? Like if that were to be maintained for several months and we were looking at, you know, let's say 2023 beef demand in the US to be down 10%, is there any recent precedent for that?
Great question. And it's not recent precedent, and it wouldn't be multiple months, but we do have history that shows that demand can swing 6 to 10% in a year in both Canada and the US, going back to 1980. So it is possible to see that big of a drop, and that's the one where is it going to hit the most is still the big question mark unknown. Previously, it had been expected that with all of the COVID stimulus, that U.S. consumers actually had very large savings going into this year that were expected to be eroded over the year to get back to something considered more normal. The question is, has consumer behavior changed where they say, we need more savings than we had historically, so we're going to stop consuming before we hit that old normal because we have a different set of expectations for the future? That's the piece that we're really in murky waters with on that side.
And one more question here. Your name, please.
Hi, I'm Marianne Posberg. I'm from the Saskatchewan Cattlemen's Association. Brenna, we were talking a bit about this earlier, so I'm going to put you on the spot again. So we had the presentation on emissions and the legislation or the possible projects in the work that could impact prices or I guess some of the work that producers have to do to verify their beef and the amount of emissions that they're doing. So because you're also working with the CRSB and you've got that kind of work with CanFax, can you kind of comment on that a little bit and how you see that impacting producers and prices?
So just so everyone knows here, I actually run two divisions at CCA, CanFax, which does market outlooks, but for the last decade, I've run CanFax Research Services, which manages a larger database, including environmental data. And so we do project management for the Canadian Roundtable for Sustainable Beef's National Beef Sustainability Assessment. And that gives a comprehensive assessment on emissions nationally, but also regionally for the East and West. And it's through that one of the recommendations in that presentation had been in terms of having a provincial or a national assessment on greenhouse gas emissions. And just so that you guys are all aware, you have that. It's in the process of being updated, and there will be a publication later this year. And the recommendation to the CRSB members that are packers or retail or food service is the fact that they can use that assessment for their scope 3 if they are sourcing cattle nationally, and if they source cattle only regionally in the East or West, they can either use that regional number. So that's one that you can say, check, it's done, and it's done for you. I think the other thing was around a protocol for carbon sequestration, and that's something that Environment and Climate Change Canada does have on the docket to work on next. And so it hasn't been started as far as I'm aware, and it would be Larry Thomas at CCA who could get you those details in terms of when that would be coming forward. One of the delays has been the science and having strong science for that. Am I forgetting anything, Marianne, from our earlier conversation? Yeah.
Brenna of CanFax, thank you so very much. If you could just hang out here for just a second, Gardner Diebold has a presentation here for you on behalf of SGA.